Imagine checking your bank account tonight and seeing $10,000 sitting there. It feels safe. It feels like your money is doing nothing. But your bank sees something very different. It sees raw material. Because the money sitting quietly in your account can become the foundation for loans, mortgages, credit cards, businesses, and entire financial systems. And the strange part is this: the bank doesn't need you to spend that money. It often prefers that you leave it there. Why? Because your money becomes useful to the bank precisely when you stop thinking about it. A bank account feels like a storage box. You put money in, you take money out. The balance changes. Simple, but a modern bank is not really a storage box. It is a machine for moving money through the economy. When you deposit money, the bank records a liability to you. The bank owes you that money. At the same time, the bank can use its funding to support assets such as loans and securities. That difference is where banking becomes interesting. Your deposit may feel inactive, but inside the financial system, money can be working. Imagine you deposit $10,000. You aren't lending it directly to your neighbor. You aren't choosing a company to finance. You aren't signing a mortgage contract. But your deposit becomes part of the bank's funding base. The bank can then make loans to customers who need money. Someone wants to buy a house. Someone wants to open a restaurant. Someone needs a car. A company wants to build a factory. Your deposit sits quietly. Someone else's loan moves loudly. That's the strange transformation. The same financial system connects people who have money with people who need it. This is why banks care about deposits. Deposits can provide relatively stable funding, and stable funding is valuable. A bank wants customers to trust it enough to keep money there, not because the bank wants your cash sitting in a vault, because predictable deposits help the bank manage its balance sheet. The modern banking system is built around confidence, and confidence is fragile. You can see that clearly when people panic. In March 2023, several American banks experienced rapid deposit withdrawals. One of the most dramatic examples was Silicon Valley Bank. Customers withdrew enormous amounts of money in a very short period. The problem wasn't simply that people wanted cash. The problem was speed. Banks manage assets and liabilities over time. If deposits suddenly disappear, a bank may need to sell assets quickly or find other funding. And when thousands of customers make that decision together, a private financial problem can become a public crisis. That raises an uncomfortable question. If banks want deposits so badly, why do they sometimes pay you almost nothing for keeping your money there? The answer is competition. Banks don't all want the same customers. They compete for deposits. But they also compete for profitable lending opportunities. And they have costs. Employees, branches, technology, regulation, capital, credit losses. Everything has a price. So the bank tries to balance two sides: what it pays for funding and what it earns from assets. That difference is part of the economics of banking. This is where one of the most important concepts appears: the net interest margin. It sounds complicated. The idea is simple. A bank earns interest from many assets. It pays interest on many sources of funding. The difference contributes to the bank's earnings. For example, a bank might earn interest on loans while paying interest on deposits. The exact numbers change constantly. But the basic relationship remains. Banks are businesses built around the price of money. And money has a price. We just don't always notice it. When interest rates rise, borrowing becomes more expensive. Mortgages become more expensive. Business loans become more expensive. Credit cards can become more expensive. But savers may also receive higher rates. When rates fall, the opposite can happen. Borrowing can become cheaper. Savings yields can decline. One decision by a central bank can ripple through millions of household budgets. The Federal Reserve has one of the most powerful positions in the American economy. When it changes its target interest rate, the effects spread through financial markets. But the Federal Reserve doesn't directly set every mortgage rate. It influences the broader environment in which banks and markets price money. That distinction matters, because your bank account isn't isolated. It is connected to a much larger machine. Now consider something banks understand extremely well. Most people don't move all their money every day. Your salary arrives, your bills leave, your savings accumulate. Some money simply sits. That predictability is valuable. A bank can estimate customer behavior using enormous amounts of historical data. How much money usually leaves each day? How much remains? When do customers withdraw cash? How many accounts become inactive? What happens during holidays? What happens during economic stress? The bank doesn't know exactly what you will do, but it can model probabilities. And banking is built on probabilities. This is why your checking account can look boring. Boring is useful. Predictable customers are easier to manage. A bank doesn't want every customer emptying their account tomorrow morning. It wants normal behavior. Deposits coming in, payments going out, balances moving gradually, millions of small transactions creating a relatively predictable system. That's what makes modern banking possible. Then banks discovered another opportunity. They could turn convenience into loyalty. Direct deposit, automatic bill payments, mobile banking, credit cards, mortgages, investment accounts, insurance. The more financial services you use from one institution, the harder it becomes to leave. Not because someone locks the door, because your financial life becomes interconnected. Your paycheck arrives there, your mortgage is there, your credit card is there, your savings are there, your automatic payments are there. The bank becomes part of your routine. And routines are incredibly difficult to change. This is why banks don't only compete on interest rates, they compete on convenience. A slightly better savings rate might attract you, but an easy mobile app might keep you. A nearby branch might keep you. A familiar customer service team might keep you. An automatic payment system might keep you. The bank is selling something more subtle than money. It's selling frictionless money management. But there is a darker side. When money becomes invisible, people can stop paying attention to it. A few dollars in monthly fees, a low savings rate, an unused account, an expensive overdraft, a credit card balance. None of these may feel enormous individually, but millions of customers create enormous revenue opportunities. The financial industry operates at a scale where tiny differences matter. A fraction of a percent multiplied across billions of dollars can become millions. And that's why the phrase "your money is sitting there" can be misleading. Money isn't simply sitting. It's part of a balance sheet, part of a payment network, part of a lending system, part of an economy. Every deposit connects to another financial decision somewhere else. Your savings may help fund lending. Your spending moves money to another business. That business deposits money somewhere else. Employees receive wages. Those wages become deposits. Then those deposits support another cycle. Money moves. And banks sit at the center of much of that movement. But banks also have a responsibility that ordinary businesses don't. They must manage risk. A bank can lend money and not get it back. A borrower can lose their job. A business can fail. A property can lose value. An economy can enter recession. Interest rates can change. Markets can panic. That's why banks cannot simply lend every dollar they receive. They operate under capital, liquidity, regulatory, and risk management requirements. The system is much more complicated than the old cartoon image of a banker taking your cash and handing it to someone else. And this is where the emotional part begins. Think about what a bank account means to an ordinary person. It's not just a number. It's rent. It's groceries. It's a child's education. It's a medical emergency. It's retirement. It's months of work represented by digits on a screen. You look at your balance and think, I'm safe. The bank looks at the same balance and thinks, this is part of our funding. Two completely different perspectives. One number, two meanings. That's why trust is the foundation of banking. People have to believe their money will be available when they need it. If that belief disappears, the system can move frighteningly fast. History has shown this repeatedly. Bank runs existed long before smartphones, but technology can accelerate them. A customer once had to stand in line. Today, millions of dollars can move with a few taps. The basic human fear hasn't changed. The speed has. So why does your bank want your money sitting still? Because stable deposits are useful. Because predictable balances help financial institutions plan. Because deposits can support lending and other assets. Because customers who stay often use more services. And because the entire banking business depends on money continuously moving through a system that most customers never see. Your money isn't valuable to the bank because it is doing nothing. It's valuable because you trust the bank enough to leave it there. That trust gives the system stability. And perhaps that's the strangest part. We think banks are places where money sleeps. They're actually places where money changes shape. A paycheck becomes a deposit. A deposit supports lending. A loan becomes a house. A house becomes a mortgage payment. A payment becomes someone else's income. That income becomes another deposit. The cycle continues, quietly, every day, while you sleep. So the next time you open your banking app and see your balance, don't just see a number, see a connection. Your money is connected to borrowers, businesses, homes, payments, markets, and millions of other people doing exactly what you're doing. Leaving numbers on a screen and trusting that those numbers will still be there when they need them. Because the most powerful thing you give a bank isn't your money, it's your trust. And in banking, trust is the asset everything else is built upon.